This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Reaching into my past. A fun interview I did a few moons ago with Alex Gracerman. Alex, who was originally trained by Larry Hite and who has gone on to great success. Also, a trend-following monologue of mine that I quite enjoyed, a misinformed view of trend following. Without any further delay, let's jump right into Alex Gracerman and my misinformed view of trend following. Well, not my misinformed view, but somebody else's misinformed view. I hope you enjoy this podcast. Today on the show, I have Alex Gracerman. He holds the position of Chief Scientist at ISAM, a specialist managed futures fund manager. 25 years of experience in the hedge fund industry. Alex initially began working with Mint Investment Management, the first managed futures advisor to manage more than $1 billion. Mint, started by Larry Hite. Larry Hite of Market Wizards fame. Larry Hite, somebody I consider a friend, a mentor, somebody who has taught me a lot. Great conversation with Alex today. And please check out his new book, Trend Following with Managed Futures. It is the definitive academic treatise on trend following. Alex brings some great color today. I hope you enjoy this conversation.
Are you still in God knows where country?
Oh, I love it. I love it. You know what? Let's just leave it like that. I think that keeps the audience guessing God knows where country. We'll circle back on the back end, maybe if we got some extra time and talk about that. Hey, let me jump right into the heart of the matter. When I had you and Larry on in the spring, I think we were right in the middle of the weekly parade of 26-year-old Financial Times reporters writing about trend following is dead. And then something funny happened along the way to the parade this summer. Even in a zero interest rate environment, in a relatively low volatility environment, all of a sudden you and your peers have started to make quite a bit of trend following money. And I know we don't want this to sound like an infomercial, but I think it's educational in the sense that a lot of people probably don't know that when you see all these epitaphs and obituaries written about trend following, well, it just hasn't worked out that way, has it, Alex?
You know, I've been around long enough to probably seen 4 or 5 of these obituaries written, maybe even more over the years, and we're still here. Last 3-4 months, things in trend following space are pretty good, but this is the nature. I mean, we've seen this in our 800-year study, right? This is not some voodoo sort of arbitrage strategy that extracts something from somewhere that, you know, that's not understood, where it could just easily end. This is a strategy that harvests natural occurrings in markets, and you know, the only way you can, I guess, permanently kill a trend following strategy is to declare all markets to go sideways forever, or to declare that no market will ever move significantly away from some sort of equilibrium, and it just doesn't happen for long enough periods of time. You know, and things move more than, as I'm sitting here, I'm looking at the yield of the 10-year note, and, you know, all prognosticators would have said that, oh, that can't go to where it is now, and here it is. But that's the nature of trend following.
Yeah, look at something like crude oil. I mean, there's been all kinds of fundamental opinions about why oil has to go up or why it's at the right price and this and that. And then, wham, bam, thank you, ma'am. The price is dropping pretty significantly, isn't it?
Yeah, nobody knows where it's going to go, but it's just in nature of people to figure, okay, things are just not going to move far away from where they are. Yet the same people will invest most of their money in stocks and hope that they'll go up 100%. This is why this kind of strategy adds value over time. For example, we're sitting here now, October 14th. Just in recent days, the equity markets have made, not major collapses, but material downturn, and things are okay in the trend following space. We're actually making money. So that's, at the end of the day, the value of this kind of strategy.
And I think it's important for people to realize you're not saying that you know what's going to happen tomorrow. You're not saying that stocks are going to continue to go down. But I think what we're going to try and point out in this conversation is there's another way to think except being only long stocks. There's something else out there. And you've been in the middle of that something else for a long time. And before we break apart some of the bigger picture issues in your new book, Trend Following with Managed Futures, I would love for you to go back in time a little bit. And I know you're not a big fan of any kind of personal stories and stuff like that. I know your personality a little, kind of just a facts guy, and I love that. And your book definitely puts that forth out there. But, you work with one of the most colorful people that I've ever met. I would love for you to talk about your first meeting, how old you were, your background, and your first meeting with Larry Hite and how you guys have come to have this great career together. It's really a fun story. And then we'll get into the book and get into some of the meatier issues. But I think the audience would love to hear that story.
Yeah, it was kind of a fork in the road that, as I look back, the joke, if you get to a fork in the road, you take it. I came to interview with Larry in 1989. I was just a kid out of school. I didn't know anything about trend following, or certainly not managed futures or details. I just needed a job. I think I was making $28,000 a year, and Larry offered me $32,000. I still have the offer sheet.
Hold on. You say just out of school. Were you 22, 26, grad school, undergrad?
21, 22.
Okay, young guy.
Yeah. Didn't really know who Larry Hite was, but this was in Millburn, New Jersey, and he was one of the guys that interviewed me. That a really interesting thing is that the Market Wizards book had either just come out or was coming out. I don't recall whether there was the actual book on the shelf or a draft of the book on the shelf, but somebody gave me in the office the chapter about Larry to read while I was kind of like waiting. And I remember just flipping to, I'm paraphrasing Jack Schwager's question, something like, what's your edge? Or something like that. And as somewhat of a scientist out of school, I would normally have expected some quite scientific answer, because I kind of heard that meant that something quantitative. So some sort of rocket science answer for what people did in 1989. But then I read this psychology stuff about how we know what we don't know. And I was like, you got to be kidding me. What am I doing here?
That was a line from Larry.
Yeah, Larry said that his edge is he knows what he doesn't know.
And you're reading this before you go into the interview.
Yeah, I'm reading this before I'm going into the interview. Interview was kind of like, okay, whatever, go home. But then, like typically you have to follow up and write a letter or an email. It was a great interview, or tell the headhunter that I really want this job. And I couldn't figure out whether I really wanted to tell him that I really wanted this job, because actually I was confused. But, this is actually, now that I see now, no different than the initial confusion Larry gives. He gave a talk in my class at Columbia last week. I teach a class at Columbia. He gave a talk to a bunch of grad students, and he confused the hell out of them too. Because it takes time to sink in.
He makes those simple statements, but the depth of those simple statements is not to be underestimated.
Yeah, it's, later on, I've obviously learned what all that means. It's the respect for risk and not getting very emotionally attached to any one strategy and those kind of things, which allow you to survive for decades and decades in the markets. But initially, just like last week in my class, I have 80, 90 graduate school PhD students, and here comes the market wizard, and they start asking him things that they think a market wizard should know, like where gold is going next week, or which way the market is going because he's some sort of a wizard. And he, of course, says he has no idea. He just needs to know what he doesn't know. And if he gets into a trade and if he's wrong, then he has to get out of it. But it is so powerful, but yet so simple. So to go back to my story, I mean, really, it's the fact that he offered me a couple $1,000s more that I ended up taking the job. But I really had no idea, no way to appreciate that, and no idea how to judge really meant or what Larry did. I just, I dove in. That's
How quickly did you know, once you were hired and you got into the office and you were around Larry, how quickly did you know this was going to possibly be your passion for the rest of your career? How quickly did you start to have that feeling?
I mean, it probably still took a couple of years. I mean, I saw the systems making money, but it took a couple of years to kind of sink in what this is about. I was like most probably geeks in the beginning and just trying to find the Holy Grail. But it's, your realization that no matter how smart you are, I mean, I see this with all my students, I joke that I try to bring their IQ down after they take my class rather than go up. Obviously, their IQ is high to begin with, but the kind of investment IQ, if you think you know everything, you'll just end up failing. So it took a while to establish kind of like the right mental equilibrium. This is, by the way, where it's hard to hire right people in this kind of area, because you need combination of two things that almost never go together, which is very, very smart people that are also very, very humble. And so you have to survive in this business. I think you need to have the right balance. If you get too smart and not humble enough, you get too emotionally attached. There's lots of people out there in the world who are very humble, but maybe not smart enough to do, at least the basic arithmetic of the strategies. So, I mean, it took me actually a while to sink in, but I've been in this for 25 years. I learned not to get too emotionally attached to, people declaring trend following dead and any of those kinds of things. But, on the other hand, not to feel like we're walking on water when we're up 30% on the year. These things come and go, but over time it works. But I wanted to make one point about trend following that I think is confusing to people. They focus too much on, the S&P or that market, obviously, because it's in everybody's portfolios. But they think, okay, the value of trend following is just kind of like to time the short side of the S&P or get them out of the long only. I have a lot of allocators who are asking me, well, what's my position in the S&P? And if I say I'm long because trend following is long, then they say, oh, but that's not a diversifying investment. Why do I need trend following? And if I say I'm short, then they say, okay, maybe that's too late. And they try to overthink this. The value of trend following is not just getting the right side of the S&P trade. It may or may not happen. The truth is that the systems are not that great in any one market. The value of trend following is that we can do this over 150 markets or however many markets one can find and really have a diversified, uncorrelated investment. I mean, that's what this is about. That's why it's worked, in our book for 800 years. If you look back at my first experience with equity market kind of shocks, it was in 1987. Mint made 60% in that year. This was, before I started at Mint, so this is in history books. But didn't make that from necessarily timing was it Black Monday, October, or was it 19th or something crash? It made its money in some corn trades and other things and other markets, and same thing in 01, 02, same thing in 2008. The value of trend following, it's not a one market thing. It's a harvesting of natural human behavior in 150 different markets.
Alex, let me interject there. I think there's been, and I'm curious your opinion on this, there's been quite a few, you see papers about trend following, the classical CTA diversified across markets like you're talking about. I think also in the last bunch of years, there's been a lot of papers about momentum. And they specifically focus only on equities. So I think there's some confusion comes from some of the academic work where it's been attempting to attach momentum only to an equity perspective and ignoring what you're talking about as this great diversification.
Yeah, so maybe this is a slightly nerdy for the audience, but there is a difference between so-called cross-sectional momentum, which is almost what all academic papers hit when the equities. This would be some kind of relative one stock to another, and more of the time series kind of momentum, which is what trend following is. We just trend follow any given market, whether it's going up and down, really unrelated to other markets. It's related in terms of the correlation and how much you risk, but not in terms of the signal. We can have no position in all markets except for one. All these equity papers are dealing with this cross-sectional momentum where you compare one stock to another and things like that, and they get into the efficient markets and whether it should exist, doesn't exist. It's just overcomplicating things. When we have 800 years of data and not simple strategies, but simple concepts. You buy high and you sell higher, and you short when it's going down and you cover lower. That works. In fact, one of the academic papers out there called by one of our competitors actually calls it time series momentum. That's what this is. By the way, anything in equities is invariably probably going to correlate to equities, even if you try to make it uncorrelated to equities. What adds value is trend following, whether it's bonds or commodities or emissions or iron ore or obviously currencies, all these other markets. And then people ask me, well, what about the interventions and the government this and the government that? And meanwhile, look where the bond yields are and how far they've gone. Things can go quite far.
The subtitle of your book, the phrase crisis alpha, is in the subtitle. So it's clear that anybody that looks at the data, that during these crises periods, that trend following, the type of trend following that we're talking about, this time series, does perform exceptionally well. There's no guarantee that things will work out that way, but it's performed that way. But what's interesting about this summer, the last bunch of months, we really weren't at a crisis period, but there still was trend following performance coming out, as I mentioned at the beginning of this podcast, from kind of a fairly low volatility, zero interest rate environment. So it's not, if somebody was to couch trend following as only crisis alpha, that would be a mistake, would it not be?
Yes. In fact, some people in our space have tried to make some kind of an excuse for some lackluster performance by calling this a tail hedge and saying, well, there was no tail. That's a total mistake. Trend following has, two great features that you probably can't find in almost any other investment. First, it's totally uncorrelated. So if you start with that, you look at the history of trend following for 10 years, 20 years, 800 years, it generates a return stream with zero to slightly negative correlation to all other asset classes. So if we take that as given, that's just, when you have 800 years of data, it's pretty close to given. It's a totally uncorrelated. It also happens to be quite negatively correlated in many periods when you want the negative correlation, which is the crisis periods, because it tends to make money from whether it's inflation shocks or downturns in equities or something else going on somewhere. Typically volatility picks up during those periods and it makes money somewhere. But it's not only that. You could take out all the crisis alpha periods or all the crisis periods, and it's still a great investment. I'd argue it's a liquid investment because we trade liquid markets. And so, people will go in their 401k plan and have 5,000 versions of the same thing, right? Small cap, mid cap, SMID cap. I heard this term recently, SMID cap, small to mid cap, or, large cap and international and this and that. And how many versions are there of being long only, which are all, call it 80, 90% correlated, 70% correlated at least? Of course, you get a little diversification from that, so fair enough. But imagine in that same 401k plan or whatever list of instruments, now there was something, called XYZ, It wasn't labeled trend following and somebody remembers, oh, I read something bad about trend following. It's just another investment, another mutual fund or another fund that somebody can put their money into. And you look at it and say, wow, this thing is just different. And it tends to work when other things don't. Well, how much closer do you get to a holy grail? I don't, maybe that's too strong of a statement, but in terms of the possibilities of what one can invest in, how much better can it be? It's totally diversifying, and there's a good chance, no guarantee, but there's a good chance that it'll perform in the periods when other things don't. So, you go back to optimization 101, any kind of optimization of the portfolio should tell you to have some allocation to that thing. In fact, we're writing a paper right now on the topic of how costly is it to not have trend following in your portfolio. How much do you give up by actually not having it, not in any particular year, but over time. And it's quite costly because you're actually avoiding a tremendously diversifying asset class.
Alex, let me jump into the idea of benchmarking, and specifically those institutional managers out there that really are fixated on stocks, and they look at the world through the prism of stocks, the long-only prism. And your firm has to deal with that. It's a constant education process. And if you look at a situation like CalPERS, they had a very small percentage, relatively speaking, with perhaps managers like ISAM. I'm not sure if they had it. I'm not saying that, I don't know if they had an investment with ISAM or not, but I'm just saying in general, a trend following. And it might have even been too small to even make a difference. How in the world, that's not the best way to say it, but how can a firm like your firm, how someone like me is trying to spread these messages to get these institutional players that control so many assets in the long-only space, and they're only worried about their career risk, frankly, to make the smart decision, to make the wise decision. I wonder if you could maybe relay a story or how you talk to people, watching people convert or watching people not convert to this way of thinking. I know it's kind of a big question, but I'm sure you see where I'm going.
Yeah, we do this all day long. And some people, we have major pension fund investors, so some people get it. It's interesting that in some parts of the world, maybe it's Australia, Canada, Middle East. I'm just kind of maybe part of the world that you're in, Japan kind of area, historically have been kind of diversification friendly. It's almost like sort of a mental mindset, maybe because, the Japanese market certainly hasn't been going up in a straight line, right? Mm. They have a lot of currency kind of movements, and those parts of the world are just friendly to the concept of diversification, right? Trend following will follow from there, but you first have to have the concept of moving somebody away from 100% equities, right? The U.S. is somehow just this, emotionally attached to this idea that, everything just will go up forever. Obviously, some institutions have allocations to this. The CalPERS thing, by the way, probably was not a managed futures issue. It was just the size of the hedge funds. They actually had a decent allocation to managed futures. But anyway, some institutions it really depends on their appetite for embracing diversification, and as you use the word benchmark, whether some form of diversification is in the benchmark. So, we look at this, what's the benchmark of the institution? And if the benchmark doesn't allow for this kind of diversification, then we can talk to them till the cows come home. They probably won't risk their career by putting it in. Because at the end of the day, a 1% allocation to trend following is not going to make any difference. It has to be 5, 10, and we have institutions who have investments with us or with some of our peers at that level, but their investment committee has embraced that in terms of their benchmark, and they've just in general embraced the concept of diversification. To some people, it's like so obvious, like, well, I can't believe that we even considered not doing it. And to some people, it's just like, okay, stocks go up forever, so why do I need to bother?
I sometimes think that it would it would take a Japanese style stock market, perhaps, to really get some people to say, we have to change. I think as long as there's going to be some people out there that as long as equities go up, seemingly in a straight line, even though there's been some 50% drawdowns the last 15 years, they're going to be hard to convince, aren't they?
Yeah, and US, I mean, the NASDAQ is in a, 15, 16, 17-year drawdown, but it's just this, especially in the US, like no matter what, it's just all about equities go straight up, equities go straight up, equities will go straight up. I don't know if it'll take a Japanese type of downturn, but some sort of a shock in the system. But again, I'm trying to tell people it's not that you just have to have that shock. Just imagine I call this, a regular mutual fund. Why not have a diversifying, uncorrelated investment in your portfolio that can do well when other things don't? You don't have to appeal to somebody's sense that, wow, this is only going to make money if you go down 100%. People try to overthink the environmental factors for trend following, and then they try to time them. Like some people just got into their heads that this only works when the volatility is high. Well, you said a minute ago that, the volatility hasn't been particularly high recently, and we've done well. There's no law that says a market cannot go. There's no law that says crude oil can't go from, 100 something down to, where is it now, 85 or something like that, in a fairly smooth line. You don't have to have massive volatility. There was a stomach virus affected lean hogs earlier this year and made prices go way up, and not particularly with tremendous volatility. It was just a fundamental event. This whole down movement in interest rates over the years hasn't been particularly highly volatile. So people think, somebody said to me, this strategy only works in high volatility environments, so I'll wait till there's a high volatility environment. Well, things are not that easy, right? By the time you get to a high volatility environment, or it doesn't work because, you have too much intervention. Well, wait a second. The intervention has caused the biggest trend of all time in fixed income.
So they want to trade your trend following strategy, huh? That they want to trade you.
Yeah, they want to trade me. People years ago used to want to time equity markets too. Remember that? People would try to time equity markets, get in and out, fund timing, all this. It's not that simple. It's not supposed to be that simple. What you're supposed to do is have a handful of diversifying investments, and, that's what's going to take your portfolio to the promised land, not trying to time. In fact, the worst thing you can do, I tell people that the worst thing you can do is to trend follower, right? To try to time it that when they're doing well, I should give them more money, and when they're doing poorly, I should take money away. That is actually the worst kind of investment you can make.
Let me shift gears on you again. I think you're fairly clear on your opinion there. The science of trend following. So we talk in the beginning of this conversation, you meeting Larry, you talk about being a teacher. You have many, many PhD candidate students at Columbia. So let's say hypothetically, so you're the top guy now, or one of the top guys now. So they come to the office, the new employee comes to the office. Obviously, in this day and age, they're going to know something about ISM. They're going to know something about you. They're going to know something about Larry before they sit down with you. But you have to introduce the science of trend following to that new candidate, that new person that you want to join your team. How do you start? I know this can go on for a long time. There's no way we can even break apart your book, the density of your book. As I told Katie, I said, you guys have put down the academic treatise that I don't know who's going to attempt to compete with. But how do you introduce to that new person in your office the science of trend following? Science and investing. This has been a relatively new phenomena that people connect these words together.
In the book, we have all these things like adaptive markets hypothesis and behavioral theory and things like that. But at the end of the day, what I would tell people is that the markets are some sort of a risk transfer mechanism. You cannot assume that just because you're smart, you will suck money out of the markets, right? If you think of it like a poker game, it could be a zero-sum game. You could be the best player, but then your profits will come down, not because your skill goes down, but because the other people at the table will just leave the game. So is it a game of zero sum kind of outsmarting people, or is it a natural phenomenon in the markets, almost kind of like providing insurance? Larry talks about this in our last talk about relating trend following to insurance. So I just say that, okay, there are natural occurring things in the markets. Let's start with something other than trend following, so we have an analogy: value investing, right? It's been scientifically, dare I say, proven or shown with data that value investing works because a lot of investors don't want to hold those stocks when they go down, and you actually earn a economic rent type of risk premium if you hold them. There are other examples in the markets where you're actually providing value to the markets by doing a certain thing. That's what makes it lasting, right? Because there's no way for 800 years you could find some gimmick that makes money where you would only do that if nobody else knew about it. There's no way you can get away with that for 800 years, right? Somebody from my class will figure it out and it'll be gone. This happens a lot with some, high frequency and those things like that. So the science is, the natural element of it is that what we're actually doing, what trend following is actually doing, is providing liquidity to the hedgers, and it's creating an equilibrium in the markets, and we have to get paid for that. That's why this works for 800 years. If the price of oil, for example, is going up, right now it's going down, but if it's going up, airline companies will almost certainly need to sell oil to lock in a future price, right? They're not in the business of counter trending. They just need to sell it to lock in a future price. We at that point buy it. Maybe it gets us a little technical, but just it's conceptually establishing the fact that it's a natural occurring thing. The markets need players like us. Otherwise, you just have a whole bunch of hedgers that, just the markets won't exist.
You haven't used the word speculation. You're speculators.
Yeah, we're speculators. And then, actually we're talking in the book, there's hedger, speculator, risk transfer, and you need to have this. But it cannot be, if you think about kind of evolutionary things, it cannot be a free lunch. If I made money on every single trend following trade, the hedgers would stop hedging. Sometimes their hedge turns out to be a good idea. Sometimes they would have turned out better not to have hedged. Sometimes, I will look better if I bought oil, or I look better if I somehow ignored that trade. Of course, we take all trend following trades, but it's supposed to be slightly painful. But, in the end, if you look at the 800 years, the data shows that the equilibrium risk-adjusted returns are pretty good. They're slightly painful. That's why you can have a couple bad years, or you can have drawdowns. If it was too good, you would have every hedger hiring a quant from my class and run, moving average systems to time their hedges. But it's the equilibrium of the markets that establishes this principle, and that's what makes it work over 800 years. But trend following is almost unique in that area. I know you talked to Katie about divergent and convergent. A lot of convergent type strategies are very limited in their capacity, very limited in what they can do, because if 5 other people discover it, it could be gone. This is just a natural thing. You called it hedger speculator. So I think that's a good answer. That's how I start with, in fact, I just hired somebody from my class that started working with me. That's how we described it. It's a naturally occurring phenomenon in the markets. Then it's just a matter of a handful of different ways of actually capturing it. But it's there. It almost cannot go away. It can temporarily, on a mark-to-market basis, not work. But it just structurally cannot disappear. Otherwise, you might as well shut down the markets and go back to communism.
Well, hey, that's a great lead in to where I wanted to go. I have a few big picture trend following type questions left, but since you had told me, and I knew by your accent, you were born in the former Soviet Union. What country were you born in, Alex?
Well, actually, I don't know. No, no. It's I've had my passport changed several times. My U.S. passport originally used to say USSR because I came to the U.S. when the USSR still existed. So technically, I was born in the former Soviet Union. But then they called me up and they said, "Okay, we need to change your passport because this new country got created called Ukraine, and now we have to reprint your passport, and now it says born in Ukraine." But now with what's going on there, right? I mean, they might call me tomorrow and say, "Okay, we have to reprint your passport. Now you were born in, I don't know, Russia or something else."
Here's where I wanted to go with though. Bringing it up though is not just for a kind of a silly reason or a flippant reason. So, do you feel like though in your career, I don't know what age did you come to America?
12.
12. Do you feel like you've had, I just relay a personal, nice achievement in your life, nice successful career. I think a lot of people would say, gosh, I wish I knew how to make those steps. Did you have an advantage coming from where you came? Was there a built-in drive or motivation that you think gave you an advantage over other peers that you might have seen in America once you got to America?
Well, I guess I know we probably don't have hours to speak about the immigrant drive, but right, that's the immigrant drive that got me to, I don't know, maybe going on interviews in an area that I had no clue about because I could maybe make more money. I mean, at that point, it was like sort of survival and making money kind of thing, not this grand idea I'm going to become a finance, person. So it's just the, bouncing around from washing dishes to Friendlies, which was my first job, to this and that to pay for school. Certainly my parents didn't have money to really, pay for anything back then. So it's just like the inherent immigrant drive to keep pushing. I had a job before I went to interview for Larry, but I wanted to do better. I don't know if there was any other advantage other than just keep pushing, keep driving, don't assume we're going to just somebody's going to hand it to you. Larry, probably you've heard stories from him, he had a disadvantage with not being able to see and those kinds of things. I had a small disadvantage in the beginning. I couldn't even speak English. So that's why I had a dishwashing job. Nobody had to tell me what to do. If there's a pile of dishes, then I had to wash them.
Meeting Larry was an opportunistic type thing because let's face it. I mean, I know from when I first met Larry, I mean, he gave me so much of his time and energy and we met so many times. And I just feel like, Larry's the type of guy that if he sees somebody trying and really pushing, Larry's the kind of guy that reaches down and says, okay, I'll give you my time. If you're really hungry, I'll give you my time. And, I feel very fortunate to have met Larry. Have not spent as much time around him as you, of course, but still it's changed my life to meet people like Larry.
I started at Mint, not as some kind of a massive. I started as a technical guy doing some Sybase programming. I was kind of like quite a low level person. Could have stayed as a technologist for any number of years, but again, it's that drive to see what else. I mean, I moved into hung close to Larry, got to know about all these know what you don't know and what he means, and kept asking him about it, and that's how I moved up. So I grabbed my opportunities. But again, that's not a Russian thing per se. It's just I call it the immigrant, the immigrant drive. I got to go get it. Otherwise it's not going to come to me.
Well, my great-grandfather came from Lithuania in the early 1900s, and they were in coal mines in Scranton, and his kids became doctors and engineers. So it happens quick when they got the drive, huh?
But I was really, at the end there, when I look back, just trend following. Washing dishes obviously wasn't going to make me money, so I had to cut the loss there, right? I did work for 1 year out of school in an engineering role. I worked for RCA on high definition television because I had a degree in electrical engineering. It was not losing me money per se, so it's not technically a losing trade, but it was just not going to take me anywhere. So I had to cut my quote unquote losses there. So, I just trend followed my way into this. Trend following is just a good general philosophy of life, right? It's not just on markets. I mean, it's how people live anyway. This is why trend following in the markets works, because that's how people are.
I want to talk about getting some meatier issues. So when people look at trend following performance across the many managers out there, and we don't have to name names, people can go look at the performance. It's all freely available. I know often I can see up and down months where you can see, okay, trend following traders had a good month. You might see double the return for one particular trader versus another, but still, it's pretty easy to see that there's dispersion amongst trend following CTAs, trend following managers. Why don't you talk about the idea of that dispersion?
Yeah, it's by analogy to equities, it's actually very simple. Initially, this is complicated. This is why, actually, a reason why a lot of sophisticated investors, like the institutions you asked me about, have a hard time getting in, because they feel like they might make dumb decisions about the space and end up picking the so-called wrong manager, the wrong trend follower, because they have no understanding of what causes differences in performance, and they get a little emotional. What makes one manager better than the other? Well, is it who made more money last year? Does that make them better? So they don't know how to step in. But actually, if you, just need to read 1 or 2 chapters in the book, it's actually not that complicated if you just make yourself aware there's a couple factors that drive performance. For example, in the late 90s in equities, by analogy to equities, the late 90s, so this is where, every internet stock went up 100% every day, and every brick and mortar stock stayed flat or went down, right? So you had this so-called dispersion between value and growth. Most investors understand that. That's why they'll have both in the portfolio. Sometimes you have dispersion between small cap and large cap. So if you make just a few, let's call them sub-classifications. So it's not just, okay, trend follower 1, trend follower 2, trend follower 3. Okay, those are the trend followers, but they have a particular focus. So if this was equity manager 1, 2, 3, the first one might have been growth focused, the second one might be value focused, the third might be small cap, fourth might be large cap. There's going to be some correlation between them because those guys are in the stock market, but there's going to be some fair degree of dispersion, and in a year like 1999 could have been 100% degree in dispersion. So now investors in long only say, okay, I go to my Morningstar little matrix, and then I need a little bit of value, a little bit of growth, so I kind of diversify. Same thing in the trend following space. You just kind of do a little bit of analysis and say, for example, the words are not the same, so it's not value growth. It's, for example, we introduce certain factors in the book like the speed of trading. So you could do trend following quite slow because either by choice or if you manage lots of money, maybe you have to be a little bit slower because of the size of your assets, or you can be a little bit faster. And you can get some different results and you can attribute them to the speed of trading. Okay. You can also have a market mix kind of bias. You could trade only kind of like the large markets, again, either by choice or because you're big, or you can be quite a bit more diversified. Like, for example, we are trading a lot of smaller markets. Well, sometimes those will cause performance differences. And so really, if you just track a few of these things, if you have to pick one trend follower, like the one, okay, you have to, I guess, interview them all and somehow pick the one. But if you would like to have a portfolio of 2 or 3 in kind of a diversified portfolio of trend followers, it's not that hard. Just look at a couple of these factors and who's tilted too slow and who's tilted too fast and these kinds of things. And you think that helps the audience. It's just by analogy to like the whole value growth thing. Just it's a little bit of effort, and then that can explain quite a bit of the dispersion between the managers. It's not just sort of random, because people are sometimes afraid, well, wait, you have 8 guys doing the same thing. and you have like this massive difference in performance. I don't know what is it. Some guy has a faster machine or bigger computers, and like they get scared because, whoa, they picked the wrong one. What is it? It's not that. They're doing conceptually the same thing, but they have certain portfolio tilts that can cause these differences. And with just a little bit of effort, one can understand them.
And speaking of a little bit of effort, and this is not a plug necessarily, but if people want to dig into even more of where you are going with all these issues, they're really going to have to pick up your book. And like I said, it's not a plug. I mean, for relatively speaking, for the price of admission, you just don't get that combination of words. I mean, as a guy who's done some work in this arena, what you guys put together is substantial, to say the least. One last question, Alex. It's all the rage in the conversations, the media, Fed watching, discussion for the last bunch of months, rate hikes, interest rates going up. Now, I'm curious because my first thought would be, and I think this has got some truth to it, we don't necessarily know what's going to happen if there's going to be a higher rate environment. We don't necessarily know how that's going to affect trend following. Give me your opinion. What's your thought process there?
We've looked at it over the 800-year data set, what happens in rising interest rate environments. But let's ask this question. You think equities might do well in that environment? I'm no prognosticator, but maybe it's possible that they won't, right? Will bonds do well in that environment? Well, almost certainly not, right? Because rates go up, then like bonds have to go down. So I would put trend following as maybe one of the few things that might do well. But let's talk about this for a few seconds, right? Trend followers are agnostic to the direction. So if yields go up, so the prices go down, we will be short bonds. Now, it hasn't happened for many years that there have been substantial hikes in the markets. But if you look at the data, we have data on interest rates from 1395. Venice issued bonds in 1395 called Venetian bonds. So we have centuries and centuries of data, plenty of rising rates environments. And I'll just simply say we will make money being short bonds if that happens. Now, people ask technical questions. If you short bonds, you short carry, will that hurt you? I mean, the chapter explains on that explains what that is. It's not really going to hurt us. There's going to be almost certainly inflationary pressure somewhere, so we probably make money off commodities. There'll be, some interest we get on cash, as it's a technicality, but most trend followers put up T-bills as margin, so we'll make more money on margin. We'll make more money on something called a roll yield in commodities because we have to roll futures contracts. When you put all this together, it should be pretty good. At least we have a pretty good chance of making money, a better chance of making money in a rising rate environment than a fixed income portfolio, let's put it that way. And meanwhile, look, some macro funds out there, not naming names, have been betting on a rising rate environment for how long? I don't know. Let's say a lot of this year, and they've been losing money on that. So look at the perils of timing. Of course, at some point rates will go up, right? It has to be a truism, maybe in our next life or something, but at some point they have to go up. But look at Japan. I mean, where's a law that says 10-year rates in U.S. can't go down more? I don't know. Meanwhile, we're making quite a bit of money on the trend that's in front of us now. When it turns, there'll be a little bit of pain when it turns, and then we'll make money the other way. This is the perils of timing, because you could sit there frozen like a deer in headlights, avoiding, ignoring what's going on now, not making money out of it, betting on a rate hike. When is it going to happen? I mean, yesterday already the Fed made some announcement, and now the market thinks it's going to happen later. I mean, nobody knows how to time those things, so just let a trend following system time it. And meanwhile, let's take the money, put in our pocket from rates going down. What's wrong with that?
I think what's so fun about this conversation is that it's been very plain talk. I think you've explained these issues just really nice, where people can walk away and say, wow, I wrapped my arms around that in a much better way than perhaps I did before listening. But then if they want to know the depth, getting back to the original idea of when Larry would introduce you to these simple concepts and then you found out the depth, you and Catherine have put that depth in a text. And I'm curious, I don't know if you know off the top of your head, how many words are in your book?
Not sure. It's 400 pages. Now, I would suggest for your readers that, first of all, don't try to read front to back, all at once. There is I'm not plugging for Amazon or Wiley, but the Kindle version is, well, A, it's a little cheaper, but B, it's actually in color. So just to let your audience know, it's because the book is, quite thick. It has a lot of graphs and charts. And I noticed the version that's on the internet, on the Kindle in color, online, is in color, and it just might make an easier read. But, it's a lot of words, a lot of topics, but it's actually not that, it's not that complicated. If you skip a few formulas.
It's got a little depth to it, Alex.
Yeah, for people who need it, But again, for a lot of people would just say, look, I can just, and I've had conversations with prospective investors from simple to very, very sophisticated. At the end of the day, if you look at it simply, you just include an investment to this because, like I said, it's uncorrelated and diversifying. If you want to know about the theory of adaptive markets and all that, then, you have that chapter. So far, we have quite good feedback on it. It's not a how-to guide. One thing I'll tell the audience, they read that book, they're not going to have some magic solution that they can start a trend following fund and compete with us. It's not about that. It's about understanding trend following and being a smarter investor in trend following strategies, understanding things like dispersion and benchmarking and what we talked about. One of the reasons we did this is just to bring some academic rigor to what's actually a fairly large industry. I mean, CTAs have a couple $100 billion, and they've never had this kind of sort of like rigorous evaluation that will help institutions. I think this will get more institutions. We just had a big consultant that put CTAs on the list of approved investments, and they hadn't done it for 100 years. One of the really, 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 really big consultants who consults to really, really big institutions, because of this kind of academic work, allows them now to be a smarter investor. They know how to benchmark. They know how to explain differences in performance. So now they can put this in front of investment committees and answer questions about that. Before, it was just a voodoo thing. Here's somebody's track record. Okay, so what? So, little by little, this will get, shelf space, and it'll get into people's portfolios and
intellectual shelf space, because there's no more bookstores out there, unfortunately. So, except I've seen them in Singapore, though. The bookstores in Singapore were really, really packed when I was there recently. So it's
a real bookstore.
Yeah. They're packed. I mean, all the current best-selling titles in America. So I don't know if it's going to go by the way.
Well, help me get this book on that list.
Well, I think it's. I don't know anything about Singapore bookstores. I did have a book that appeared on their bestsellers list a few years back, but I'll see if I can dig up some info for you that can perhaps help. Wiley, for one thing, we'll just get on Wiley and say, hey, guys, we want this baby, because they love that kind of detail. I mean, it's the only place in the world where a taxi driver has ever recognized me. And let's face it, I'm not exactly writing about, topics that are, James Altucher or more famous people. I mean, a taxi driver recognizing a guy that writes a book about trend following? Come on. So yeah, I'd get on Wiley about getting in those Singapore bookshops.
Okay.
That's my pitch. Okay, Alex, people can go to isam.com, and I think there are some papers that that everybody can take a peek at if they go to the site.
I think so, yeah. Or find me through Columbia. We do, as a business, a high degree of education. This is how the book actually came about. We had been writing white papers for a while. We have a white paper coming out actually this week on an interesting topic. Maybe it'll be the first chapter of the next book. So continuing the education. There's a big thing right now, just to ask myself and answer a question quickly. There's a lot of mutual funds forming, sort of liquid alternatives, a lot of so-called cheaper versions of trend following being offered. I want to educate people on, what you get for what you pay for, and be careful about those things. But you will have now you have mutual funds that you can buy that do trend following. So the access points will be will be easier for people. They just need to be able to evaluate what they're getting. But it's going to become, the train is out of the station. It will become more mainstream.
Let's leave it there, Alex. Great conversation. I appreciate you coming on today. And like I said, everybody can go to Amazon, Trend Following with Managed Futures, Alex Gracerman, Catherine Kaminsky. Easy to find, easy to buy. Hopefully we can talk again in the future, Alex. I'm going to have to get Larry on for a really long conversation too. Alex, it was great talking, and hopefully we can talk again in the future.
Thanks, Mike. Bye.
Take care. I want to play a small clip. David Harding has had a rough time on CNBC over the years. No, I'm sure he personally has never felt too rough. David's a pretty smart guy. He's been pretty successful, but he's gone on CNBC many times, and he just gets these god-awful questions. People don't know what they're asking him. They don't know what they're doing, or maybe they have a slight agenda. If they're Joe Kernan, Joe just doesn't seem to like the idea that David might have these strategies, these quant trend following strategies. But David always keeps a stiff upper lip. He's always very calm, cool, and collected. It makes the case for trend following. And he's been consistently doing this on these CNBC interviews for multiple years now. I've played excerpts of the clips on my podcast. And I'm going to play another one today because David is leading the charge. And I love the fact that he's leading the charge. But recently, after having this Joe Kernan interview that was just awful, I think the second one that was awful, David appeared on CNBC, and it looks like he appeared at his offices in London, and a very nice lady, a very attractive lady from CNBC, interviewed David. Great interview. She did a nice job. I think she let David explain and expand upon what he does. Let me play a small clip.
When I started trading in or studying the futures markets in the 1980s, I teamed up with my partners and we used computers to do something rather predictable, really, which is we used computers to test some of the popular ideas of trading strategies for making money in financial markets. And perhaps the most popular of popular trading ideas was trend following. And you have a set of rules which says, go with the flow, buy soybeans when they're going up. And we tested all these rules and we found that as far as past data concerned, they worked. This is very surprising. They're not supposed to work, certainly not according to the academic orthodoxy. The efficient market theory says that the market has no predictable patterns in it whatsoever. So we were faced with a choice between the evidence of our senses, the fact that these strategies appeared, however you looked at it, whichever way you turned them, you've turned them upside down or inside out or back to front, they just worked and worked and worked on past data. That didn't mean they were going to work in the future, but it was encouraging. On the other hand, the theory is that they can't work. So as young men, we were faced with either backing the evidence of our senses or going with the orthodoxy. And fortunately, we did what young men and women do, which was we took a gamble and started a company. And we didn't, of course, know that these ideas would work, but surprisingly and conveniently, they have worked for the next 25 years. And that's about the amount of time you need to build a successful business, which is what I've managed to do on the back of it.
Of course, that's a very straightforward introduction from David. Trend following is a very well-known quantity, a very well-known strategy to anyone that's awake. Now, yes, I admit that I do have a firm called Trend Following, in full disclosure. And hate me for registering the name trendfollowing.com back in the mid-1990s. Hate me for it. But guess what? I alone am not trend following. Trend following is a strategy that you could argue goes back, I believe it's David Ricardo, 1700s, and a fantastic paper that outlines trend following history by Stig Osgard, one of the turtles. It's free on the internet. Take a read. But trend following goes back a long time. I mean, it is the strategy that's about finding a positive mathematical expectation across a diversified portfolio. It's the idea that on your trading, you're going to have 30 to 40% winners. Your winners are going to be much bigger than your losers. You're going to cut your losers short quickly. You're going to have a lot of small losses because you're never going to know when the markets are going to trend. That big picture that I just described right there is employed by David Harding. It's employed by Larry Hite, by Ed Seykota, by Richard Donchian in the 1950s, by Bill Dunn, by Ken Tropin, by the guys at Aspect Capital, TransTrend. You name it. Go down the list of the podcast episodes that discuss trend following on my show. Yes, I am happy to lead the charge for my world about trend following. But trend following is a strategy, and it's well known. Now, of course, you've got to do a little homework. You might have to read something. You might have to know a little bit more than what the system or the machine has told you to believe. If you wake up each day and the only thing you know about investing is what the Fidelity family tells you, buy and hold, value, this, that. Yeah, sure, you might not know about trend following. But for those with a pulse, pretty well-known quantity. Which leads me into what I described on Twitter on August 5th at 3:09 p.m. I put a tweet out and I said, the most misinformed description of trend following seen yet. And I linked to a Bloomberg article. I sourced the author, a guy named Noah Smith. I had no idea who Noah Smith was. That's not taking anything away from Noah. I didn't know who he was at all. No clue who Noah was. God, the article was terrible. The trend is your friend till it isn't. Following stock market trends seems like a good idea, but it usually ends up costing investors money. So I read this article, and he talks about trend following being related to the hot hand fallacy. Compares trend following to option sellers selling deep out of the money options. Now, of course, for those out there that know something about trend following is long volatility. Trend following is the exact opposite of that. Literally, it's like writing an article comparing trend following to the strategies of long-term capital management. You know, the idea that you walk out there and you try and pick a nickel up in front of a steamroller. And boy, that's such easy thing to do. And then one day the steamroller runs over you. Trend following is the opposite. It's the opposite strategy. So clearly this author got it way wrong. He's not even close to the strategy of trend following. The strategy of trend following employed by many men and women over the decades, having pulled billions upon billions of dollars of profit out of the market. So again, I make one tweet. I say this is just a terribly misinformed article. I don't know the author. Boom! Here comes the fight back. I guess I should have known. I should have known it was coming. So let me go over some of this. And I think there's good lessons to be here. This isn't like a retrospective because I got into, I don't know what they call this, a tweet war or something. So I called this guy out. I basically said he was clueless. I said, get a clue, please. That was my original tweet. He responded finally, and a bunch of other people jumped in. It wasn't like I was the only person in the industry to say, hey, this guy got it really wrong. And all he had to do was correct himself. Now, I should take a step back. I later found out that this guy is a pretty popular blogger. And he has his PhD, and he teaches finance or econ. It's Stony Brook, I believe. Seems like a pretty young guy. Maybe he didn't know what trend following was. I don't think he did, clearly. Or he had some vague idea of something else and was using the wrong terminology or the wrong jargon. Who cares? He got it wrong. Just wrong. I called him out. He responded with question marks. To my tweet, he responded with question marks. I asked him if he knew what trend following was. He tried to change the subject, called me a guru. I think somebody jumped in and said, well, I've got books to sell. I gave him a bunch of links to third-party research papers. He immediately came back. Now, I thought this was really, it's telling. I mean, here's a guy who's writing for Bloomberg. He seems to be a known quantity. And he immediately comes back and he assumes the links I'm giving him are self-serving pieces that I've written or something. And he says, well, to the effect that if I force him to go down this path and he finds something unsavory about me, that could be bad for me. And I just kept saying, hey, look, just change your article. You got it wrong. Just investigate, find out what trend following is. I told him to fix the article. That's basically what happened. This poor guy, he kept lashing back out. Oh, there's multiple definitions of trend following. And that trend following was a marketing buzz phrase employed by me. So trend following was all about me, all about Mike Covel. Now, clearly, this is a guy who tweets, I don't know how many tweets he tweets a day, but a lot. So he doesn't really have time to get off the soapbox. He doesn't have time to do any homework, right? He's just got to respond and save face in the moment of right now. And this is society today, right? Respond and save face in the moment of right now. Now, mind you, I wasn't trying to pick a particular fight other than to say his article, his perspective was clueless. That's not an attack. It was a factual statement. And what I will never relate to about society today is the response is not to take your medicine and say, I was clueless about that. No, it's the ad hominem attacks. It's the straw men. It's the red herrings. It's the change the subject. It's Mike Covel's an evil motherfucker who can't possibly know what he's talking about. Come on, look, I've been down the path of these kinds of fights and battles so many times in the last 15 years. So I don't take any of this stuff personally. I mean, if you really, if you get your jollies off by calling me names or whatever you want to call me, I mean, bring it on. That's whatever gets your rocks off. I really don't care. Again, I was only after the very narrow issue of trend following in his article being characterized in the wrong way. And I was simply correcting. Now, maybe I should have said something nice in my original tweet instead of calling him clueless, but clueless was a fact. So I have this little go round with him, and then one of his followers jumps in. One of his followers jumps in and says that trend following is a class of strategies. That I should feel bad for having a business. I can't speak to the risk or legitimacy of these strategies. And it gets better, that I was really unfortunate that I exist, not as a human being, but as a character I've created in order to make a living. And this is where the subject of this debate gets more interesting, to me at least. And this is the societal problem. Is when I started to watch these guys, you start to watch their minds turning, even in a few tweets. They didn't like that I was coming out and saying this. Because I make money in a way they don't like. They didn't like that I was coming out and saying this because I didn't get a PhD. I never had a desire to get a PhD. If someone has one, great. There are some brilliant people with PhDs that have appeared on my podcast. But you know what? Every last one of them has been humble as you know what. And the whole PhD thing is not part of the message. But that was different with this. You could just feel it. Covel doesn't have the academic chops. Covel doesn't have the insight to tell us about trend following. Now, I don't really feel the need to defend myself in terms of what I know or what I don't know. I'll let the market decide that. But I have put a fairly decent dent into the arena about the subject of trend following across 5 books, a film, and a podcast that seems to keep growing. So when I think about this little exchange that I had, I see lots of lessons. Again, it's a great opportunity to clarify what trend following trading is. If you don't like the fact that part of my business has to do with trend following trading, if you don't like the fact that I've written books about trend following, and somehow or another, because I have written books about trend following trading that happen to be sold in the marketplace, that I'm incapable now of having an honest or accurate or objective view on the subject. How messed up is the thinking of some people out there? Because what I really find interesting is this angle of where does one make their money from? Right? Where does one make their money from? Everyone has to get paid. That means you in the audience, the folks that I'm debating in this little interchange that took place. Oh yeah, they got to make money somehow or another. Noah's getting money from some university to teach econ classes. I teach people, not at a university, not at econ classes. If you don't like it, that's great. If someone doesn't like Noah, that's great. But everyone has to get paid. And if you do it in an honest way, if there's a track record for how you do it, if there's an understanding of what you do, it always cracks me up how some of these folks out there in the system think that they've got the holier than thou approach. That there's this only one way to go about life. And the way you go about it is memorizing everything from the age of 6 years old, all through grade school, middle school, high school, college, graduate school, getting your doctoral thesis completed. And then you will have arrived. I'll tell you right now, there's a hell of a lot of PhDs out there. And I will be cocky for a second. They've made far less of a dent on a major subject than I have. And that should be inspiration to those of you that are listening out there. Because it's not about the old system. It's not about the old system. It's about getting it right. What's the story? What's the concept? What are we arguing? What are we trying to learn? In this case, it was trend following. In my mind, it was a much larger issue. It was a much larger societal issue. Because they wouldn't back down in the face of. Maybe this is this millennial generation. They can't admit to being wrong. They can't just say, hey, I made a mistake. They have to save face. And the way they save face is just smile and make accusations and say crazy stuff in response. Why go over this in depth? I think it's useful. I think it's useful to understand how people think. This is the advantage you have as a trader, as an investor. This is what you're up against. Oh, will trend following continue to work? Will trend following be dead? How can it with so many people not having a clue? A lot of issues in this little monologue, a lot of different things peeking out behind the curtains in society. I must tell you, I'm so glad that I don't watch cable news on a regular basis, that I don't have to know about some of these debates, that I'm not trying to put out 100 tweets a day. At some point in time, everybody has to acknowledge this information overflow, this information overload. There's too much. How the hell do you ever enjoy your life if your ego is so fragile that the only thing you can do is just to keep tweeting massive amounts of tweets out just to keep it going because you're so worried in that one moment that somebody is going to see you as weak, where everyone already sees you as weak to begin with. So what happened? What was the end result? Well, as I was preparing for this podcast, I went back and looked. And it appears Noah Smith, the professor, the reporter, the writer for Bloomberg, deleted all of his tweets. So the entire conversation we had back a week ago, my tweets are all still there. His are all gone. So I can only imagine at some point in time, somebody tapped him on the shoulder and said, hey, shut up. You don't know what you're talking about. Somebody finally said to him, hey, you got this wrong. Now in his world, I looked at his feed. In his world, this is one minor subject, right? One minor little thing. I, however, like the subject of trend following. I like getting it right. I like showing people about it. I like having guests on my podcast that get it right. So if I see an article, I don't care who the reporter is. I don't care who the writer is. If they say something really, really inane, I'm going to rip them. I'm going to rip the content of the article. I'm going to rip the writer. If they want to correct it, they can. If they want to have one of these interchanges with me, they can. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.